Welcome to another detailed technical analysis on our channel. Before we dive deep into the charts and evaluate the projections for the EURUSD pair, it is imperative that we take a moment to review our legal disclaimer. Trading foreign exchange, commonly known as Forex, along with various other financial products, carries a significantly high level of risk. It is a complex financial activity that, due to its inherent volatility, may not be suitable for all types of investors. It is essential to understand that all content shared in this video is for strictly educational purposes and represents personal technical analysis only. Under no circumstances should this information be interpreted as financial advice, investment recommendations, or specific buy and sell signals. Capital management is an individual responsibility. You are solely responsible for the decisions you make in the financial markets based on your own judgment and risk management. Trading responsibly is the first step toward long-term survival in this environment. With that being said, get ready, because we are about to break down the price action of the euro against the dollar and identify the key liquidity and reaction zones for our trading session today. Now looking at the EURUSD chart on a one-day time frame, we can observe a highly interesting technical scenario as we are in New York hours, right in the pre-opening period of the London session. This time window is crucial, as it is when institutions typically position their initial intentions before the injection of European volatility. If we look closely, the price has been interacting with very precise historical liquidity levels. We have several PDH, previous day high, and PDL, previous day low, points marked, which act as magnets for the price. At the top, the levels from January 29th and 30th stand out near the 1.1980 and 1.1990 zones, areas the price previously rejected after a considerable bullish expansion. More recently, we see resistance levels at 1.1928 and 1.1890, which coincide with the February 12th high. However, the most relevant factor in the short term is the current bearish pressure. The price is testing critical support levels. Notice the PDL, previous day low, marked at 1.1846 and the support level immediately below at 1.1832. The fact that we are trading below previous highs suggests that the market is seeking liquidity at lower levels. If we look at the bottom of our chart, we have clear liquidity targets at 1.1809 and, deeper down, in the 1.1765 area corresponding to the February 6th PDL. The current structure shows solid-bodied candles indicating a downward distribution. Tracking the price on this daily timeframe allows us to filter out intraday noise and understand that, as long as we fail to recover and close above the 1.1874 zone, PDH, the bias remains defensive. We are closely monitoring the reaction at this current level of 1.1832. A sustained break here would open the doors to visit levels not seen since late January, specifically the major support at 1.1728. Refining our analysis, we now move down to the 12-hour timeframe to observe price delivery with greater precision. In this timeframe, the bearish narrative becomes even more evident. We can see how EURUSD is consuming or systematically taking out the liquidity from previous lows. After the rejection at the upper PDH levels, the price has generated a series of distribution candles that have pierced through the PDL, previous day low, at 1.1846. Currently, the market is trading right at the 1.1833 level, putting pressure on the February 12th low. This action of consuming the lows indicates that the institutional order flow is seeking counterparties in the support zones marked in red. The speed at which the price approaches these zones suggests that the immediate target is to test the 1.1809 level. We must stay alert to see if the price simply grabs liquidity and reverses, or if the 12-hour candle closes confirm a continuation toward deeper levels. Dropping down to the 8-hour timeframe, the price displacement becomes much more evident and aggressive. After breaking the structure at higher levels, we observe a succession of bearish candles with extended bodies and short wicks, validating the strength of the supply at this moment. The price has decisively pierced the PDL, previous day low, at 1.1846, turning what was previously support into an immediate resistance zone. This displacement shows us that the market is not only seeking liquidity but also has a clear intention to expand the range to the downside. Currently, EURUSD is hovering dangerously close to the 1.1830 level. The lack of a significant bullish reaction after sweeping the previous lows suggests that the selling pressure has not yet peaked. The next logical target for this expansion move is the February 9th PDL zone, located at 1.1809, where we expect to see if institutional demand emerges or if the displacement continues with the same intensity. Observing the 4-hour time frame, we find ourselves at a critical moment of the day, the prelude to the London Open. In this time frame, the bearish displacement we have been analyzing is consolidating with a structure of lower highs and lower lows. It is clear how the price has respected the PDH zone at 1.1874 as an impassable ceiling, starting a controlled but steady decline from there. Currently, EURUSD is hovering over the February 12 PDL at 1.1832. The formation of the last few 4-hour candles shows a clear intention to invalidate this support. In institutional trading, we know that just before London comes into play, price often seeks external liquidity zones. With the February 9 PDL located at 1.1809 as the immediate visual target, the market seems to be setting the stage for a major bearish expansion once European volume kicks in. The question now is whether London will use this current support for a deep retracement or drive the price directly toward the next demand zone marked in red. Dropping down to the 1-hour time frame, the picture becomes more dynamic. We are not only seeing price action aggressively breaking the February 12 PDL, but we must also factor in the fundamental side. For today's session, the euro faces significant volatility catalysts, such as the German and Eurozone ZEW economic sentiment indices, along with the ECOFIN meetings. These news events often trigger sharp moves. Notice how the latest hourly candle shows a solid bearish expansion just ahead of these releases. The market seems to be pricing in negative data, driving EURUSD to seek deeper support levels as traders digest European economic sentiment. With the London session now in full swing, the 1-hour timeframe reveals our operational structure for the day. At this stage, we have established critical benchmarks, the high daily at 1.1852 and the recent low daily at 1.1828. Notice how the price, after an initial bearish impulse, has left pending liquidity above in the form of equal highs near 1.1870 and a BSL, buy-side liquidity, level at 1.1863. Nevertheless, price continues to respect the bearish bias, staying below the PDL at 1.1846. The area between the February 12 low, 1.1833, and the new daily low is now our consolidation zone. London is defining the range. A sustained break of the low daily would confirm a continuation toward the next major target, while any retracement will first seek to clear the equal highs liquidity before deciding the next directional move of the day. As we prepare for the transition into the New York session, it is vital to keep our charts clean and updated. We have removed liquidity zones that have already been mitigated or invalidated by recent price action to avoid visual noise. Instead, we can now clearly identify a new 1-hour order block that the price has left behind following its latest bearish displacement. This order block, situated just below the high daily at 1.1852, represents an institutional supply zone where price could find resistance in the event of a retracement. Notice how the market has established a defined range between this block and the new low daily at 1.1828. For the New York Open, we will monitor whether price seeks to test this zone of interest to continue its bearish structure or if, conversely, it begins an accumulation phase. Identifying these fresh supply levels is key to anticipating where large sell orders will enter during the second half of the trading day. It is 7:53 a.m. in New York, and on the 1-hour time frame, we are witnessing aggressive institutional movement. Price is not just testing the low daily at 1.1828, but is actively sweeping all the liquidity accumulated in the lower zone. Notice the wick forming below the previous low. This is a clear sign of capturing sell stops to find counterparties. This sweep is happening just minutes before the Wall Street Open, a classic scenario of manipulation or search for external liquidity. As long as price remains below the 1-hour order block and the high daily at 1.1852, the structure remains bearish. However, this rate on the lows is the catalyst we were waiting for to see if New York will drive EURUSD toward the next major support level or if a retracement will begin after clearing this zone. We have spent a considerable amount of time analyzing this 1-hour chart, and the reason is clear. The 1H order block we have marked is the central axis of our current narrative. This order block, stretching approximately between January 1840 and 1.1852, has acted as both a magnet and an impassable barrier during the recent candles. Notice the precision with which the price interacts with the lower boundary of this block. Despite attempts at recovery, EURUSD fails to print a candle body close above this supply zone. This prolonged stay on the chart confirms that institutions are distributing positions within this range. As long as price continues to hover here without a clear break of the high daily, our working hypothesis remains tilted toward capturing the liquidity that still resides below the low daily at 1.1824. It is now time to see if New York finally injects the volume necessary to break out of this equilibrium zone. We now drop down to the 15-minute timeframe to experience the price action in real time. We are less than 1 minute away from the official New York session open, and market tension is palpable. Look closely at the latest candle formation. After sweeping the low daily at 1.1824, the price has generated a very significant sell-side rejection candle. This pronounced lower wick indicates that, despite previous bearish pressure, buying volume has entered or massive sell positions were closed right in this external liquidity zone. The fact that this rejection occurs moments before 8:30 a.m. suggests that New York might attempt a reversal move or, at the very least, a retracement toward the 1H order block we marked earlier. In trading, these rejection candles at critical support zones are early signals that the dominant force is meeting resistance. Get ready, because the Wall Street Open is about to inject the volatility needed to confirm if this rejection has bullish continuity. We officially welcome the New York session. With the clock striking 8:30, volatility has made its grand entrance. On this 15-minute chart, observe the price behavior following that initial rejection wick. The market has returned exactly to the same previous level, creating what we call equal lows in the 1.1824 area. For an institutional trader, equal lows are not just support, they are a massive reserve of liquidity. Below these levels lie thousands of retail sell-stop orders. The fact that EURUSD is respecting this level for now suggests the market is building a base to entice more buyers before deciding whether to conduct a final sweep of all that accumulated liquidity. Keep your eyes on the high daily at 1.1852 and this new equal lows support, as a break of either point will define the bias for the remainder of the morning. Just 1 minute after the open, the equal lows theory is confirmed in the most aggressive way possible. The liquidity that was pooling at 1.1824 has been completely neutralized. As you can observe on the 15-minute timeframe, price has pierced through that level without hesitation, searching for what lies beneath. This acceleration has delivered a new low daily, currently sitting at 1.1819. It is a masterclass in how institutions use obvious support levels to generate the necessary counterparties for their sell orders. Now that price has cleared the immediate lows, our attention shifts to the next external liquidity target, the February 9th PDL at 1.1809. There are no signs of a bullish reversal yet, the order flow remains bearish, and price seems magnetized toward those historical support levels we marked at the beginning of our analysis. As the New York session progresses, we further refine our technical view on the 15-minute chart. Following the liquidity grab of the previous lows, the price has left a new zone of interest, a 15-minute order block located just below the larger 1-hour block. Observe closely how the price, after a very weak recovery attempt, reacts almost surgically upon contacting the base of this new 15M block. This zone is now acting as flawless technical resistance. We see no candle closes above it, indicating that institutional order flow continues to push the price lower. The price action is clear, every retracement is being used to load new sell orders. As long as this 15M order block remains intact, the bearish bias is absolute. We are witnessing confirmation that the market intends to continue exploring lower levels, keeping the recent low daily under pressure and aiming directly at the external liquidity still pending at the bottom of the chart. Now, look closely at the exact point indicated by the blue arrow on our 15-minute chart. Following the formation of the new 15M order block, the price made a controlled retracement move to test the base of this supply zone. The arrow marks the precise moment when EURUSD touches the block and immediately reacts with a sharp rejection. This upper wick you see forming right at the blue arrow is the confirmation we were looking for. Institutional order flow is defending this level. There is not enough strength to close above it, making this block a solid resistance for the New York session. These types of reactions validate that institutions are taking advantage of every small bounce to continue injecting sell positions, keeping the clear objective of breaking the current low daily at 1.1815 and finally heading towards the major external liquidity from February 9th. Continuing our 15-minute reading, the reaction we previously highlighted with the blue arrow has taken effect. As you can see, the rejection at the 15M order block was not an isolated event, it was the start of a new downward impulse. EURUSD has lost the temporary support it tried to build and is now heading with a very clear bearish intention to pierce the last low daily we had established. It is fascinating to observe the precision of the order flow. Price uses the supply zone to recapitalize and continue its expansion. At this moment, selling pressure is dominant, and there is no trace of demand that can halt the slide. We are in the final minutes before the full New York volume enters the market, and everything points to the target still being the external liquidity from higher timeframes. Keep your focus on how the candles are closing with solid bodies below the previous lows, which is a technical confirmation that the intraday trend is firmly under the seller's control. The New York session open is officially underway. With the full volume of the American markets hitting the charts, EURUSD confirms the narrative we have been building. Observe how the 15-minute candle, after respecting the order block and the highlighted resistance, expands forcefully to the downside. We are witnessing the decisive break of the previous low daily. This structural breakout indicates that the bearish sentiment is not only dominant but is accelerating with the Wall Street Open. In this scenario, the lower liquidity zones we marked on higher timeframes become immediate magnetic targets. There are no signs of absorption from buyers. On the contrary, every attempted pause is absorbed by new institutional sell orders seeking lower prices. The market structure on the 15-minute chart is now a clear succession of bearish impulses and retracements, confirming that New York's strength is aligned with the daily trend. We now switch to the 5-minute timeframe to observe the immediate price action in greater detail. After hitting the new daily low, EURUSD has begun a corrective move to the upside. As you can see, the price is heading decisively back toward the 15-minute order block zone we marked earlier. This behavior is very common following a strong expansion. The market seeks to rebalance or mitigate pending orders in the upper supply zones. This is a high-tension moment for traders, as we are watching whether this approach to the order block will act as an impassable resistance once again or if the price will have enough strength to close above it. For now, the move appears to be a simple technical retracement to find a better sell entry. Keep your eyes on the 1.1828 level, as the reaction at this point will determine if the bearish bias remains firm for the rest of the morning session. For traders seeking absolute precision, we now drop down to the 3-minute timeframe. In this frame, the retracement toward the 15-minute order block is seen with total clarity. Notice how EURUSD has slightly penetrated the supply zone, but the 3-minute candles show constant upper wicks, denoting strong selling pressure at the 1.1825 levels. There is no bullish impulse with conviction. On the contrary, every candle that attempts to move up is quickly rejected by institutional orders. This microstructure confirms that the price is simply recapitalizing before continuing its downward path. The low daily at 1.18158 acts as a visual magnet right now. By observing this level of detail, we can confirm that the internal structure remains aligned with the major trend, and any sign of exhaustion in this retracement will be the final signal to look for expansion toward the February 9 PDL liquidity. Finally, we land on the 1-minute timeframe to dissect the movement with surgical precision. At this level of detail, we can observe how EURUSD is actively building new zones of internal liquidity. Notice the formation of local equal lows at the 1.18193 area, marked just above our main low daily. This microstructure is essential for understanding market liquidity engineering. By creating these equal lows on the 1-minute chart, the interbank algorithm induces scalpers to place their stop losses right underneath. As long as the price continues to respect the ceiling of the 15M order block seen at the top, these small supports are destined to be swept. Visualizing these zones confirms that the market is accumulating the necessary energy for a final expansion move. We are monitoring the price behavior candle by candle, expecting this internal liquidity to be consumed to drive the pair definitively toward the major target at the 1.1809 PDL. Staying on the 1-minute timeframe, the blue arrow now points us toward an extremely precise zone of interest, a new 1M order block. Notice how this small cluster of orders formed right after a failed bullish recovery attempt. This zone represents the final gasp of demand before sellers regained absolute control. Visualizing this zone is fundamental to our execution. Observe how the price, when attempting to move higher, is immediately rejected upon touching the base of this block. This micro-timeframe resistance acts as a technical ceiling that keeps EURUSD pinned against the equal lows at 1.18193. As long as we don't see a breakout of this 1M order block, the probability of the price piercing the low daily at 1.18158 remains extremely high. It is the perfect validation that institutional liquidity is positioned to sweep the lows and target the higher timeframe support levels we defined at the start of the session. Market dynamics on micro-timeframes can change in a matter of seconds, and what we are seeing now is the perfect example. If you look at the blue arrow, the price initially respected our 1M order block, but the latest candle has completely shifted the narrative. A bullish candle with a disproportionately large body has appeared, piercing through and closing above our resistance zone. Technically, this high-magnitude candle invalidates the 1-minute order block. When a supply zone is bypassed with such speed and volume, it indicates that buying pressure has taken momentary control, likely seeking a deeper correction toward higher levels from the London session. In trading, the ability to accept a zone's invalidation is what separates professionals from amateurs. Despite this impulsive move higher, we must not lose sight of the macro context. We remain below the high daily, so we will monitor whether this jump is just a search for higher liquidity before resuming the main bearish path. We return to the 1-minute timeframe to fine-tune our perspective. Following the expansive move that invalidated the previous zone, the market has left a clear new institutional footprint. We have located a new 1M order block. This block represents the last consolidation zone before a move with intent, and it is vital to observe how EURUSD behaves upon retesting it. As you can see on the screen, the price reacts almost instantaneously when contacting this new block. This response confirms that the level holds relevance for high-frequency algorithms. Notice the pause and subsequent rejection. It is a demonstration of how order flow seeks equilibrium zones for positioning. Although the structure has shown volatility, the interaction with this OB provides us with a solid technical reference to understand market sentiment at this precise moment in the New York session. Price continues to speak through these zones, and our job is to interpret each reaction without losing sight of the major liquidity targets still pending at the bottom. We return to the highest level of detail on the 1-minute timeframe to observe a flawless technical execution. Look closely at the blue arrow. It marks the precise moment when the price returns to test our newly formed order block. The reaction is immediate and forceful. As you can see, the moment the candle touches the shaded zone of the block, the bullish momentum comes to a sudden halt. The blue arrow helps us visualize how the institutional order flow is trapping liquidity at this level. There is no follow-through above the block. Instead, we see a pause that suggests heavy absorption by sellers. For a trader, this is the visual confirmation that the zone is valid and that institutions are defending their positions. These types of reactions are exactly what we look for to validate our market hypothesis, keeping in mind that as long as this ceiling holds, the path of least resistance continues to point toward the sweep of the equal lows and the low daily marked below. We return to the 1-minute chart to follow the evolution of our zone of interest. As indicated by the blue arrow, price has not only reacted to the edge of the order block but is now moving with clear intent to consume the center of the block. In institutional trading, we know that the 50% mark of an order block is a highly sensitive area where the largest volume orders are often concentrated. Observe how the candles penetrate the shaded zone, seeking that internal liquidity. This move is crucial. The market is filling pending orders before making its next expansion. Despite this move into the heart of the block, the larger structure continues to exert pressure. We are monitoring whether this consumption of the OB center acts as the ultimate fuel for price to finally reverse and look to sweep the equal lows at 1.18195 and the low daily at 1.18158. The precision at these 1-minute levels is what allows us to understand the exact timing of institutional moves before the session's major shift. We return one last time to our 1-minute chart to observe the climax of this technical setup. The blue arrow now precisely points to the price contact with the exact center of the 15-minute order block. Notice the immediate reaction. After consuming the internal liquidity of the zone, EURUSD has formed a forceful upper rejection wick. This is the confirmation we were waiting for. The price attempted to pierce the block, but upon reaching its midpoint, institutional supply entered strongly, invalidating any short-term bullish continuation intent. The blue arrow marks the end of the retracement and the start of what appears to be the final downward impulse. With this rejection confirmed in a highly sensitive zone, all eyes now turn to the lower levels. The liquidity at the equal lows and the low daily is now at the market's mercy, and the 1-minute structure indicates that the path is clear to finally seek the major target at the 1.1809 PDL. We return to the 1-minute chart to analyze a vital concept in order flow reading. I want you to look closely at the blue arrows pointing to the yellow zone located in the center of our 15M order block. As you can see, the price has returned to this level on multiple occasions. In institutional trading, there is a fundamental rule: the more times price touches an order block, the weaker it becomes. Every time EURUSD enters that yellow zone, it is consuming the sell orders that were pending there. The blue arrows show us this constant drain of liquidity. Although the zone initially acted as solid resistance, these repeated touches suggest that supply is being exhausted. We are at a precarious point of equilibrium. If the price continues to press into the yellow zone without achieving an aggressive rejection toward the lows, the probability increases that the block will eventually be pierced, seeking higher liquidity levels in the London structure. We return to the 1-minute chart to observe the price action's development. As we anticipated, the price has bounced once again off the order block zone, but pay attention to the most important technical detail in this capture. During the retracement move, EURUSD has generated two very evident liquidity points in the lower area, now marked as SSL, sell-side liquidity, at 1.18239 and 1.18233. These levels represent a liquidity pool just above our equal lows. The fact that price bounces off the upper block again while creating these lower lows indicates that the market is building the perfect exit ramp. Institutions often generate these fake support points to entice retail buyers before performing the final sweep. Now, we have a high probability scenario: a weakened order block above and a massive accumulation of liquidity below. Everything suggests that the next strong move will be the takeout of these SSL levels to finally target the low daily at 1.18158. We have reached the moment of truth in our 1-minute analysis. I want you to observe the strength of the move following the last rejection at the upper block. As we have been warning, the price has initiated an aggressive bearish expansion with a clear objective: consuming the lower liquidity. Notice how the current candle slices through the SSL levels we previously identified at 1.18239 and 1.18233 with total ease. There is no pause, confirming that institutions are clearing the market of retail buy orders. This liquidity sweep is the fuel the price needs to accelerate toward its final goal. With the equal lows now neutralized, EURUSD is heading unimpeded toward the low daily at 1.18158. It is a perfect demonstration of how the market uses liquidity accumulation to generate fast and efficient directional moves. Having the patience to wait for the upper zones to weaken was key to anticipating this vertical descent. We return to the 1-minute chart to witness the master move of the session. Notice how the price, after sweeping the lower liquidity, performs a small bullish impulse that leaves a new internal BSL, buy-side liquidity, at 1.18257. This move is a classic induction trap for buyers. Immediately after, EURUSD executes the turtle soup model, a fake breakout of that recent high to capture stops and react instantaneously within our upper order block zone. Look at the precision: the price touches the block, triggers the reversal model, and begins to plummet with institutional speed. This combination of an upside liquidity grab and an OB rejection is the ultimate signal that supply has taken total control to close the day. There are no more doubts. The market has cleared both sides of the range and is now heading with its full weight toward the low daily at 1.18158, validating step by step every order flow concept we have analyzed today. As we can observe in this final stretch of the 1-minute chart, the strategy has played out with institutional precision. Following the turtle soup formation and the final rejection at the order block, price has accelerated its decline, breaking through the last intraday support levels. This analysis demonstrates that trading is not about guessing the future, but about interpreting the footprints left by institutions through liquidity and order blocks. I hope this tutorial has been highly useful in improving your technical vocabulary and market perspective. If you enjoyed this content and want to continue learning about professional price action, please subscribe to the channel, hit the like button, and share this video with other traders. Your support is essential to keep bringing this type of educational content. Remember that I am fully available to answer any questions. I will respond to all your messages, whether here in the comments section or via email. Thank you very much for joining me today, and I'll see you in the next analysis.